Kevin, it is great to have you back on the show. It's been a minute. And I know you're sort of looking for the leaders of what you're calling the leaders of the new American economy. And this has been an investment theme for you. Has your view on this changed at all throughout the pandemic? I mean, if anything, some of these leaders that you're looking at have only become stronger.
Yeah, I think it's actually strengthened throughout the course of the COVID-19 pandemic. I mean, consider that the S&P has now rallied over 52% from the low that it hit on March the 23rd and stands with a total return gain of over 6% year to date. Who would have thought that back in February and March? But the themes that we see going forward, given how stretched valuations are now in the stock market, are the areas that we believe will be the leaders of the new American economy emerging from the COVID-19 pandemic. Clearly, the way that we work and the way that we operate and the way that we shop is going to change, likely forever. So how do investors benefit from those changing themes? We think they look to invest in areas such as healthcare, notably biotech. We think areas such as consumer discretionary, notably e-commerce. And then, of course, technology, but not necessarily, Jules, just big cap tech, but more so revolutionary technology such as artificial intelligence, robotics, and of course, cybersecurity, which is of the utmost importance given how many people are working and shopping remotely.
So, Kevin, first, it's great to see you again. I'm glad you're with us. I am curious. Let's break it down simply. Let's look at healthcare, biotech, for instance. Right now, there are several companies getting hundreds of millions of dollars from you and me, from taxpayers.
Yes.
But we know historically, only 30% of vaccines that ever get through a trial actually work.
Yes.
There are going to be a lot of investors in biotech and healthcare who are going to be really disappointed a year from now.
Yes. And I think what you're seeing, Adam, is that the vaccine candidates are coming from mostly big pharma, whereas it's the smaller cap biotech companies that are coming out with the therapeutics and the treatments for other chronic diseases. And if in fact that's the path forward, well, you can look for those large cap pharmaceutical companies to be a lot more acquisitive of the smaller cap biotech companies. And that's where we see the investment opportunity.
Hey, Kevin, who are the losers in your new American economy? We know who the losers of the COVID recession are. It's obviously restaurants, travel, and a lot of retail. But going beyond that, longer term trends, who loses out?
I think, Rick, it's those who don't adapt to the changing societal norms and also the changing ways in which we interact business. Those who do not embrace technology, those retailers that don't build out an online footprint, those companies that don't allow for a more gradual remote workforce. All of those companies stand to be left behind the new American economy. So it's not necessarily just energy or financials. It's not a sector play as much as it is the companies within those sectors that need to adapt and change and evolve. And if they do, well, then they stand to potentially benefit, Rick.
Any names?
Of the companies that don't stand to benefit,
yeah,
or the companies that do stand to benefit?
The companies that aren't adapting.
Well, that's what we're going to see over time. You know, I've spoken on this show a number of times about the Amazonification of the U.S. economy, and I think we're starting to see that trickle through into other industries as well. The credit card companies, the payment processors, the delivery companies, the online search engines, even the industrial REITs, the warehouses and distribution centers, they're all adapting. But investors need to be mindful that the days of volatility are not behind us, Rick. In fact, they could ratchet up again as we get closer to the election. And of course, we need to see if there will be an agreed upon additional round of stimulus and what happens between U.S. and China in regards to trade. A lot for investors to grapple with right now.
Hey, Kevin, what do you see happening after the pandemic is over? Do you see these pandemic stocks or pandemic rallied stocks falling back down to earth? And then should investors start to kind of move away from those and perhaps back into stocks that they may have been focused on prior to the pandemic?
Sure. And I think valuation is very important right now. Consider that the S&P is trading at a PE of around 26. Its 10-year average is 18. That's pretty excessive from a historical norm. But that doesn't mean you still can't find pockets of growth opportunity ahead. And I believe coming out of COVID-19, clearly those companies in the e-commerce space should still continue to benefit. the need for innovative healthcare solutions isn't going away either. In fact, it could only increase as we see additional viruses, God forbid, or chronic diseases that we've yet to find cures for. And then, of course, technology, the ability for us to be able to communicate efficiently and securely has only increased in value. So those companies in those specific areas may be trading at excessive valuations, but that doesn't mean they can't move higher. So look for those companies in those areas that have strong balance sheets, entrenched management teams, a history of growing their earnings. And if they pay a dividend too, well, that helps given the importance of dividends in the total return equation.
So, Kevin, it sounds like I was going to ask you about valuation, but you brought it up, of course. But does this mean that people should be willing to pay up for these companies that you're talking about, that this is not a sort of bargain hunting kind of time?
Yeah, and I get that question a lot, Jules, as it relates to, are we going to shift back to value now, given the excessive run that growth has been on? And I don't think it's necessarily a one or the other type of decision, because certain companies, whether it's an Amazon or other online e-tailers like eBay or Etsy or even stamps.com, they might be trading a little bit high relative to their historical PEs, but that doesn't mean they can't move higher moving ahead. So I think investors would be wise to look underneath each company, see if in fact they have excessive amounts of debt on their balance sheet. Do they pay a dividend? Do they have free cash flow? And how are they adapting to this changing society that we all find ourselves within? And of course, diversification, Jules, I know I say this every time I'm on, but diversification is key. And investors shouldn't change their risk tolerance just because the S&P is now up 52% from its lows, and they shouldn't also change their tolerance if in fact volatility does return. It's more about time in market than it is about market timing.